it's been a very good first quarter, driven by good production of oil and gas on the Norwegian continental shelf, particularly gas, because the gas demand has been high in Europe. But also this quarter has been characterized by increased gas production in the U.S. We had some acquisition of new fields in U.S. last autumn, and they already deliver quite a lot of good results for us this quarter. But of course, it's been a turbulent time, and we are also kind of focusing on being resilient, improving our balance sheet, cost focus, and capital discipline.
Talk to us in more detail about that. How are you protecting the business given this uncertainty and the turbulent times that you just highlighted?
Yeah, so with the good results we have maintaining the capital distribution and both the share back and the cash dividend. And we're doing so by kind of focusing on ensuring that we keep up the production, safe and efficient production, that is securing the income. And we have had one of the highest production efficiencies ever actually this quarter. It demonstrates the solidity in our core business. At the same time, we are focusing on cost, making sure that we have reduced some of the early phase costs and also focusing on capital discipline, only sanctioning the projects when they're good enough. And this will enable us to have a robust balance sheet, being robust and resilient towards all the external shocks that we're seeing at the moment in the macro environment.
I would also like to get your thoughts on the renewable side of the business. I know in the past you've said that you are reducing investments in this part of the business to about $5 billion US. I'm wondering whether at this stage you are reconsidering that and actually planning to cut the investments in this side of the business even further.
We were constantly focusing on only sanctioned projects that have the required returns. The $5 billion is based on the projects under execution. If there will be any more projects, that will be based on the market situation, the cost of this project, and the return of these projects. So far, not necessarily cutting more of those $5 billion, but constantly focusing on making sure that we are not sanctioning new projects before they have the required return. So on longer terms, this can affect the total capital expenditures.
Now, we've also seen one of your minority shareholders raising the point that they would like further explanations on how raising investments on oil and gas actually aligns with your commitment to the Paris climate deal. What's your response?
Well, there are no kind of one single framework for Paris alignment for companies. The Paris Agreement is for countries. What we're focusing on is to ensure that we are reducing the CO2 emission for the oil and gas that we are producing. We are investing in non-oil and gas business. And we're also making resilience tests, demonstrating to our investors that we can withstand really low oil and gas prices if demand goes down due to the energy transition. So with these three elements, we can demonstrate that we are resilient also towards different net zero scenarios and so on. So that will be our response to those investors.